Getting to Zero Tax Part 1, the 0% Bracket. This is the 39.6 Facebook and YouTube Live Finance Show. A daily show thus far for the past, 60 days. Wow, we're on almost 2 straight months. Crazy. And this is the show that teaches high earners like yourself how to make your money work for you so you don't have to work for your money. We talk general investing, taxes, real estate, childcare, syndications, Airbnb, paying for college, and even the car you drive. Oh, good. We got one person in the YouTube community. This is exciting. I'm growing an audience here. Today we're going to start talking about getting our taxes down to zero or close to it as a continuation of tax week. As a refresher, 3 days ago, we did episode number 83. That was Physician on Fire's tax return. Please review that for information about the above-the-line deductions and the itemized deductions versus standard deduction, things like that. And also a little bit about credits. But this is the 1040 flows. Then we talked about the marriage penalty yesterday, which a lot of people had never heard about. So that was pretty exciting. And the day before, I had started to release my new tax graphs. So I have continued to work on my new tax graphs. I had some mistakes that I was able to figure out the formatting with, and I'm very excited now they are clean and looking the way I want to, at least for right now. I'll probably continue changing them, but I'm very happy with the way they are at the moment. So getting to zero tax, we usually focus on the bigger graph, like the $1 million graph, and have a lot of people over there at the 37% bracket. But it's really important to understand how the lower tax brackets work, because you want to be able to utilize these every single year for the rest of your life to minimize your tax liability. You want to fill up your 0% bracket every single year. Those are taxable dollars that you don't pay tax on. Okay, those are tax-free dollars. It's basically kind of like Roth money. You have every year tax-free money. Now, usually that 0% bracket, you can't really see it in the bigger graph because it's so tiny. So, for example, when I show the $1 million graph, let's see here. It is stuck at the moment. There we go. If we show the $1 million graph and it doesn't want to show, I have to take it off. I'll put it back on. Okay, well, it won't show. But the $1 million graph, the 0% bracket is super, super tiny. So you don't really get to see it. Okay, so I have created a new chart. Okay, here it is. Here it is. Here's the $1 million graph. Okay, so here's the $1 million graph, and the 0% bucket is super thin. Okay, if I go to the $2 million graph, the 0% bucket is just this tiny little smidgen at the bottom left corner there. Can't even see it. Okay, now these are all going to be married filing jointly graphs for today. I also have them all for single/head of household separately. I also have them all for all three combined, but the more stuff you put on there, the harder they are to follow. Okay, so as you remember from yesterday's topic and the day before, married filing jointly is always cheaper. Well, the brackets are lower for married filing jointly. You can have a marriage penalty, a small amount, but the brackets are lower. So since we're talking about getting to zero and the 0% bracket, we're going to first assume that you are married. Okay, it will make things easier. If you're single, your brackets are just smaller, but the principles are still there. Okay, so we're going to go back down to the $200,000 graph that I have here. Okay, and so this is income on the bottom up to $200,000 adjusted gross income. So remember, you have like your gross wages, your W-2 income, then you have adjustments, and then you get to adjusted gross income. Okay, you also have other sorts of income like dividends or other business income, pensions, IRA distributions, all of those incomes. Put them all together, subtract out your adjustments, you get your adjusted gross income. And that is before you take the standard deduction or itemized deductions. Okay, so I'm going to make this graph bigger, make me smaller, and take off my label here. Okay, so on the bottom is your adjusted gross income. I'm going to put the mouse so that you can hopefully see it. Maybe you can't see it. Okay, can't see it at the moment. Maybe if, okay, well, you can't see it. That is frustrating. Let me just save this quickly as a picture and see if that will help, because I think it worked yesterday. I am just going to save it to my desktop real fast. And okay, let me just see if that works. I apologize because I want to be able to show my mouse. If I can't show my mouse, it makes it a lot harder to actually follow what I'm doing. So I'm going to take off that screen share. I'm going to screen share again. Application window. There we go. Okay, here we go. I saved it as a picture and now you can see it. Perfect. So I'm going to zoom in on this. Spotlight. There we go. Now you can see me and you can see the graph and you can see my mouse. So you can't see the mouse in Excel, but you can see it on a photo. Now I understand. Okay, so we have adjusted gross income on the bottom, trying to make this as big as possible. And you can see my mouse here. So on the left side on the bottom, that is your 0% bracket. Okay. For married people, the standard deduction, okay, that standard deduction is about $24,000. Okay, and so from 0 up to 24,000 is actually a little bit more than that, but approximately 24,000. All the way up to $24,000 is all 0. Okay, now if you are itemizing and you have more deductions than the standard deduction, that 0% bracket gets wider. So let's pretend you have $50,000 in itemized deductions. Well, you're not going to take the standard deduction anymore. Okay, you're going to itemize. So this entire graph is going to get shifted over so that it's not going to go up right here. It won't go up until you get to 50,000. And then the entire graph will be exactly the same, but the entire thing shifted over by $26,000. Okay, so your 0% bracket is just now wider. Okay, so the key to getting to 0% tax is for your adjusted gross income to be within your own personal 0% bucket. Okay. That's the first premise. So whatever you need to do to decrease your adjusted gross income can get you closer to this 0% bucket, whether it is not working. Let's just pretend you decide to not work and take a year off. Then your wages are lower. And so your adjusted gross income will be lower, and you could very easily be in the 0% bucket. Okay, you could just, for example, be taking money from your dividends from your investments. And if that's a small enough number, then you don't have to pay any tax. Okay, so when you're retired, you can strategically take money out so that your taxation is very low. If you're just taking, let's say, $24,000 out of a pre-tax IRA every year when you're retired, and you're not taking any Social Security, and you don't have any other taxable income, then you're just living in the 0% bracket, even though you're taking money out every year, and you don't have to pay taxes on any of that. Okay? So it's actually pretty easy for retired people, if they're not taking Social Security, to pay 0 income tax with nothing fancy at all. You could just be taking money out of a Roth IRA when you're retired. If you're not taking Social Security, you have 0 taxable income. Now, that wouldn't really be smart to do because you're not filling up that bracket. You're not filling up that 0% bucket here. You want to fill up the 0% bucket every single year. So when you're retired and you're not taking Social Security, what you could do is you could take money out of a Roth IRA, okay, not pay any tax on it. And if you have any pre-tax money, you could do a Roth conversion of $24,000 of it, fill up that bucket, and replenish some of that Roth you took out. Okay? So you want to fill up that 0% bracket every single year, ideally of your entire life. Now, while you're not retired and you're earning, you want to get your income down. Okay? The freebies, the easy things, are just to fill up every single pre-tax investment account your company provides to you if you're an employee. So that could be a 401k, could be a 403b, could be a 457, it could be a combination. You could have a pension plan as well. There are a lot of people who are not happy about people not paying a lot of tax. Yet, almost everybody does not fill up their pre-tax investment accounts at their job, or even just a regular traditional IRA that is available to all Americans. So unless you are doing picking off the lowest hanging fruit, then you're not doing what you can do to decrease your tax liability, because that income that you're putting into a 401k, that's income that doesn't even show up on your W-2, doesn't even show up on your taxes at all on your 1040. When you put in that first box for W-2 wages, that money is not even there. So if you made $19,500 at your first job for the year and your only job, and you put $19,500 into your 401k, you will have no money on your 1040. You will be in the 0% bracket. Okay. So you can do a lot of things to decrease your income, to decrease your AGI. And we're going to cover that a little bit more in subsequent episodes. But those are very easy things to do. Just not even receive the money in the first place. Okay. Now, this green line is the federal income tax. And you can see that, for example, when you get to $30,000, okay, you start paying a little bit of tax, and it's not much money. So these lines on the right side, each small line is $1,000. Okay, so for $30,000, you're paying like $500 in tax. If you have $40,000 of income, you're paying like $1,500 in tax. If you're getting $50,000, you're paying around $25,000 in tax. So you can just follow this line, and when you get to $70,000, you're up to just $5,000. I might have missaid one of these. So $2,500, and then $70,000 of income is only $5,000 in tax. The median American household makes less than $70,000. Okay, so that's most Americans here, or like half of Americans are paying $5,000 or less in income tax. Now, even when you get up to $100,000, which is probably around 90% of Americans, maybe a little bit less now, you're still paying less than $9,000 of income tax. And that's just without taking any other deductions. That's just straight $100,000 of income, standard deduction. You're paying around $8,500 in income tax. You don't hit the 22% bracket until you hit around $105,000. Okay, so for a lot of people, when they're retired, you have a nest egg that's pre-tax and you have a bunch of money in there. You may want to consider using up not just the 0% bucket, but the 10% and the 12% bucket every single year, even if you don't need to spend $105,000. If your taxable income, like on December 29th, is only $80,000, you may consider doing a Roth conversion of $25,000 to fill up the remaining 12% bucket. Okay, in doing that, yeah, you would have to pay 12% tax on that money, but then you're getting money out at only 12%, which is still very cheap in comparison to paying almost twice as much for the next dollar. So you may want to have a strategy of using up these 10% to 12% buckets in retirement. If your pre-tax bucket is pre-tax investments is very small, you may just want to fill up the 0% every year. Okay, and then there are people who have a lot of money pre-tax. They may want to fill up the 22 and the 24% brackets every year, all the way up to 24%. It just depends on how much wealth you have in each of these buckets and what your goals are. Okay. Now, I focus on this green line because that's the tax you actually pay. If you want to pay about $1,000 in tax, you can have $35,000 of adjusted gross income. Now, remember, adjusted gross income comes before you. So on this graph, I'm using the standard deduction. So after you apply standard deduction to your adjusted gross income, the last part of your taxes is your credits. Okay, your tax credits, and these are the best. It's $1 credit, saves you $1 of tax. Some credits are refundable credits where it can bring your income so low that the government literally pays you back, so your tax rate is negative. You are getting paid by the government. You get all your money you paid plus more. Now, the most commonly taken tax credits are, for example, the child tax credit, which a lot of people did not qualify for before the Tax Cut and Jobs Act. But when that came out, it changed the limit on income. So anybody who makes $400,000 or less is eligible to take a child tax credit of $2,000 per child. It didn't used to be this way. It used to be only for lower income earners, but they gave you a deduction for each child as opposed to a credit. When they changed the tax system, they increased the standard deduction all the way up to $24,000 instead of like $12,000. But then they took away the deductions for children and they increased the child tax credit. It makes taxes a lot simpler. I've seen a lot of posts in the past 2 days online about people saying, I wish the tax code were simpler. It is so much simpler now than it was 5 years ago. They got rid of a lot of things. The vast majority of Americans are taking the standard deduction. We are taking the standard deduction for 2019. It makes taxes way simpler, okay? But it's still complicated, right? Now, those child tax credits are worth $2,000 per child. I can't find online where there's even a limit as to how many tax credits you can get. If you have 20 children, you could have $40,000 of tax credits. Now, there is a limit as to how much you can deduct. If you only have like $30,000 of tax that you would have owed and you had 20 children, that would be $40,000 of credits. And $30,000 of tax with $40,000 of credits would be $10,000 the IRS would pay you. They're not going to write you a check for $10,000 to have your 20 kids. I don't know anybody's got 20 kids, but I'm sure there are people in the world, maybe not as much in America, but have 20 kids. But they will actually give you a refund up to like $1,400, a refundable credit beyond paying all your taxes off. They will give you up to an extra $1,400, from my understanding. So let's take this situation. Okay, you have a household with 3 children. Okay, and in this household, they make $80,000. Now, $80,000, taking the standard deduction, hits right around here, just a hair over $6,000, maybe $6,200, $6,100. Let's say $6,100 of federal income tax. Well, you have 3 children, and they're all under 17. It's either 17 or 18. I think it's under 18. So they all qualify for the child tax credit. So instead of paying $6,100 in tax for the whole year, it would only be $100 in tax. And a lot of families have 3 kids, and that's just the child tax credit. There are other credits. There's also the child care credit. Okay, and it has like a little bit longer name than that, but I discussed it before in an episode a few weeks ago because we actually qualified for that child care credit. That was episode number 60, the child independent care credit. We actually got a very small amount for 2019. So that credit maxes out at $2,100, and that's to offset the cost of dependent care, like daycare expenses. Okay. If you have like $6,000 of daycare expense, and if your income is low enough, then they use a 35% multiplier on that 6,000. 6,000 is where it caps. And so 35% times 6,000 is $2,100 of a tax credit. So let's pretend that same household has $80,000 of income. Okay, $80,000 of income, and they have 3 children. So you're back up here. You're sending one of two, let's say 2 of those kids also go to daycare. Okay, so and your income is low enough, and you qualify for the full $2,100. I think it'll actually be less at this income level. Let's just say it's $1,000. Okay, so $1,000 tax credit for dependent care, and $6,000 of tax credit for this being having children, the child tax credit. So you'd actually go from $6,100 down to negative $900. So what would happen is you would file your taxes. Every single dollar of tax that you will have had withheld from your paychecks will be paid back to you as a refund, plus an additional $900, because part of that tax credit is refundable. Okay, the child tax credit will go refundable $1,400, and the dependent care tax credit, I don't know the extent of the refundability. Okay, this one is not refundable, but the child tax credit is. Okay, so you would actually get a refund of all your taxes plus a little bit extra. So you can actually see how a lot of Americans and families are paying very, very, very little tax, and that their tax filings are super simple because these tax credits apply to so many Americans because they don't phase out until you get to $400,000 of income. And that would only apply to a small percentage of Americans, like 2% of Americans or so. So the vast majority of Americans, they will be able to actually qualify for a substantial amount of tax credits, especially if they have a family, and can get their income tax close to zero. So there's a very high percentage of Americans who don't actually pay much in the way of tax because they don't have to, because the tax system is designed such that people with lower earnings and even middle class people are able to avoid much of their tax. Okay, so one more example, you could have somebody making $110,000. They're paying only 10% effective tax rate, even less than that, just above 9%. So they're paying about $10,000 in tax. So family, $110,000 combined. They have 3 children, and you have all the way down from $10,000 all the way down to $4,000 in tax. And that's just taking the standard deduction and not qualifying for any other tax credits. Now, let's pretend you have somebody in college. Okay, there are other credits. There's the lifetime learning credit, and there's also the American Opportunity Tax Credit. The lifetime learning credit is up to $2,000, and it goes all the way up until, for married people, up to $116,000. Okay, so that's another $2,000 credit for having somebody in college. And the American Opportunity Tax Credit is another one up to $2,500. Okay, and there's some differences between these, but these are significant. And then there's also the Savers Tax Credit. This used to be called the Retirement Savings Contribution Credit. And you have to have up to $64,000 of income if you're married, $32,000 if you're single. But if you contribute money into retirement plans, you can get a credit for up to $2,000 if you're married and $1,000 if you're single. So if your income is low enough and you put money in there, I see they're trying to incentivize people to put money in, and you're basically getting a match from the government because they're going to give you $1,000 or $2,000 just for putting in based on how much money you put into your own retirement accounts. So that is actually IRS matched dollars. And that could be in addition to the dollars that your employer is matching you. So if your income is low enough, you should definitely take advantage of these opportunities. So there's a lot of ways for most Americans to actually get down to zero tax, or like $1,000 of tax, maybe $750 in tax, which would correspond to around $33,000 of adjusted gross income. But if you have children and you get those tax credits, it's not hard to get yourself down there if your income is $100,000 or less. Okay. Once you get into the $105,000 plus range, now you're in the higher tax rates. Your income tax goes up much faster. Okay. Which is why it's very important to take advantage of those things you can to help keep your income here in the blue zone. Okay. So a lot of Americans are paying very, 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 very little tax. Easily like half of Americans are paying very little tax. When you look at what percentage it is in terms of what their effective tax rates are, most people are paying definitely under 10% tax. About half of Americans are probably paying less than 5% effective tax rates. So super low amounts compared to people who are six-figure earners, especially if you're on W-2. All right. That is it for tonight's episode, part 1 of getting to zero tax, 0% bracket and credits. We are going to continue this discussion maybe tomorrow, maybe the next day. Until then, this is brought to you by our sponsor, the Medicine, Marriage, and Money podcast. Episode 3 this week with Tiffany Moon, available on iTunes, Apple Podcasts, Spotify. Directly from Libsyn, you can go to the webpage, medicinemarriageandmoney.com. That's medicine, marriage, and A-N-D, money.com. Again, this show is strictly for my entertainment, hopefully yours. This is not to be considered formal, official, or even any form of advice, financial, legal, accounting, or otherwise. Until tomorrow, have a great night.